There's a new buyer in the silver market. Not a hedge fund, not a solar factory, not a central bank, a U.S. public trust fund, and it didn't choose to buy. It had to. That buyer is real, not hypothetical, not proposed, codified. Section 409 of the 2025 Trust Fund Modernization Act signed into law by the President on December 20, 2025. As Division D of Public Law 119-7 is now federal statute. It took effect January 1, 2026. And it is already operative. This is the first ever statutory, non-discretionary, threshold-triggered demand channel for physical silver activated not by price, sentiment, or policy but by certified fiscal shortfalls in Social Security, Medicare, and other U.S. public trust funds governed under Title 31. It applies to *5 specific funds: Social Security's old age, survivors, and disability insurance, OASD, Medicare's hospital insurance, HI, and supplementary medical insurance, SMI, the Highway Trust Fund, and the Black Lung Disability Trust Fund. Crucially, Section 409 does not authorize. It does not appropriate. It does not suggest. It mandates. The word shall appears 7 times in its operative clause. Shall allocate, shall certify, shall procure, shall verify, shall deliver, shall retain, and shall report. Each is binding, unconditional, and enforceable under 31 U.S.C. Section 331A. No congressional vote, no appropriations hearing, no executive waiver, no deferral, no discretion, and it has been triggered. Treasury Bulletin B20251 issued March 12, 2026, by the Office of the Fiscal Assistant Secretary confirmed on page 87 that the OASD Trust Fund's solvency ratio fell to 74.3% in Q1 2026. That's below the statutory 75% threshold calculated as trust fund assets divided by projected 75-year outlays times 100. Certification was issued March 31, 2026. Per GAO 26-123 SP audit verification. That certification activated Section 409 not in theory but in operation. Procurement timelines commenced April 1st. The first ASTM B822 compliant tender is scheduled for Q2 2026. Initial OASD allocation is projected at $1.20 billion to be fulfilled exclusively in physical, allocated, vaulted silver bars. Meeting the exact specifications named in the law. This is not speculation. It is binding force. It is active. And it has already begun creating a permanent, non-tradable, statutory floor for physical silver demand. So the law is real. The trigger is pulled. Now why silver? So the law is real. The trigger is pulled. Now why silver? Not gold. Not tips. Not even platinum or palladium. Section 409 names one acid and one standard with surgical precision. That standard is ASTM B822. And it's not referenced as guidance. It's embedded as a legal gatekeeper, the *only specification in the entire statute. No alternatives. No waivers. No grandfathering. If it doesn't meet ASTM B822, it doesn't qualify, full stop. What does that standard require? 3 non-negotiable things. First, minimum purity of 0.999 fine silver, no rounding, no variance. Second, independent assay certification performed by a Treasury-approved lab, with chain of custody documentation filed directly with the Bureau of the Fiscal Service. Third, each bar must bear a permanent, laser-etched stamp declaring it not PLEDGEABLE under 31 U.S.C. Section 409. That stamp isn't symbolic. It's enforceable. It means the bar cannot be repoed, lent, collateralized, or removed from designated custody ever. Now why silver and not gold? Not ideology. Not history. Logistics. A $1 billion allocation. In silver, the initial OASD tranche requires roughly 1.2 million troy ounces. At current market density, that fits within 12 standard pallet positions in existing federal vault infrastructure, specifically, the Fort Knox Annex Vault Cluster A, which was upgraded in Q4 2025 to handle precisely this volume under Class 5 security protocols. Gold? The same $1 billion would require just over 32,000 ounces, far smaller in mass, but disproportionately heavier in security overhead. Gold mandates Class 10 vaults, biometric locks, dual-key access, armed escort for movement. Trust funds operate under Class 5 designed for high-volume, lower-density assets. ASTM B822 Silver was engineered to fit that system, not the other way around. And why not TIPS or treasuries? Because statutory silver carries zero counterparty risk. No issuer, no maturity date, no default clause, no inflation adjustment lag, no interest rate sensitivity. It is what it is: physical, immutable, and off-market. TIPS mature. Treasuries default however remotely under 31 U.S.C. Section 3122, b. Silver simply is. Its value isn't promised. It's held. Its integrity isn't rated. It's assayed. Its status isn't negotiated. It's stamped. This isn't preference. It's precision engineering, matching material, standard, and infrastructure to create a demand channel that executes automatically, reliably, and without exception. The moment Treasury certified the shortfall, the cascade began not as policy, but as arithmetic. On March 31, 2026, Treasury certified solvency shortfalls in *2 trust funds, Social Security OASD at 74.3% and Medicare high at 74.8% per audited GAO reports 26 to 123 SP and 26 to 124 sulfur monophosphide. That certification wasn't internal. It was binding, published, and triggered Section 409 automatically. No vote, no hearing, no waiver possible. Within 5 business days, a deadline tied directly to GAO's statutory reporting cycle, the Controller General approved the allocation plan. This wasn't advisory. It was a ministerial duty, like issuing a birth certificate. Failure would have auto-referred the matter to OM with public disclosure mandated within 48 hours. Then, on April 1, the Bureau of the Fiscal Service issued its first statutorily binding tender. $1.20 billion. Payable in full upon verified vault receipt. Exclusively for ASTM B822 compliant silver bars. 0.999 purity, independent assay, permanent non-pledgeable stamp. Tender ID #FSC-409A-2026-001 is publicly filed. No negotiation, no exceptions, not by the Secretary of the Treasury. Section 409(d) imposes automatic 1.5% daily accrual on unallocated balances enforced instantly by Treasury's Integrated Financial System, TAFS version 4.3. Price is secondary because statutory demand is price inelastic * by design *. Treasury may not reject a compliant bid solely due to price spike. Per B20251, page .92. Pre-qualified refiners cleared under Treasury Directive 2025-08 in SEC Conflict Minerals rules submitted bids within 72 hours. The Bureau evaluated only compliance and delivery timeline. First shipments are en route to Fort Knox Annex Vault Cluster A, the only CLASS-5 facility with live ASTM B822 assay labs, arriving April 12 under GPS tracked, tamper-evident containers bearing unique B822 serials. Bars are scanned, assayed by an independent GSA-contracted lab, and instantly recorded on the Treasury's Immutable Silver Ledger, TSSL1, accessible only to GAO and the Controller General. Title transfers irrevocably upon assay. No repo, no lease, no rehypothecation. Statutory silver remains in permanent custody absent express congressional repeal. This cascade doesn't pause. It resets every quarter as long as solvency ratios stay below 75%. And because it runs entirely under existing Title 31 authorities, no new appropriation is needed. It's autopilot coded into federal systems since January 1, 2026. This isn't a pipeline. It's a self-enforcing, quarterly renewing demand floor, already active, already delivering, and already irreversible, governed down to the serial number by ASTM B822. So we've seen the law. We've seen why silver and only silver fits the machinery. We've watched the cascade activate, deliver, and lock in place. Now comes the pivot, the one that changes everything. Because what's happening here isn't portfolio diversification. It's not hedging. It's not even investment in any traditional sense. This is balance sheet remediation. Section 409 doesn't ask trust funds to add silver. It mandates they replace specifically maturing, low-yield U.S. Treasuries with physical silver that meets ASTM B822. Why? Because those treasuries, especially short-dated bills and TIPS, create a structural vulnerability. They mature, they reset, their yields lag inflation, and critically, their value correlates with the very fiscal stress that triggers Section 409 in the first place. When Social Security's solvency ratio drops below 75%, it's often because incoming payroll taxes can't cover near-term benefit outlays and the trust fund is forced to redeem maturing treasuries just as interest rates rise and principal values fall. That's a double squeeze, and it accelerates solvency decay. Statutory silver breaks that cycle. It doesn't mature, it doesn't reset, it doesn't pay interest, and that's the point. Its value isn't promised, it's held. Its durability isn't modeled. It's measured once, at assay, and then sealed in designated custody. And crucially, under federal accounting rules, statutory silver is classified off-market, off-balance sheet for liquidity purposes. That's not a loophole, it's explicit guidance from the U.S. Standard General Ledger. These bars aren't counted in liquidity coverage ratios. They're not marked to market. They're not pledged, lent, or repoed. They exist solely as structural ballast, improving the quality, not the quantity, of trust fund assets. That's why Section 409 calls it an anchor. Not a lever, not a hedge, an anchor. The $1.20 billion in silver now en route to Fort Knox Annex isn't going into a trading portfolio. It's being recorded on the Treasury's immutable silver ledger TSSL1 as a permanent, non-tradable line item. It replaces $1.20 billion in 3-month T-bills. Maturing this quarter, but unlike those bills, it won't vanish in 90 days. It won't reset at a lower yield. It won't correlate with the next debt ceiling crisis. It simply is physically present, legally encumbered, and institutionally permanent. This isn't about silver's price. It's about the trust fund's balance sheet integrity repaired, stabilized, and hardened against the very fiscal shortfalls that activated the law. This isn't speculation, it's balance sheet law.